Good morning. Hi, it's Mary Ellen McGonagle, and this is the MEM Edge Show, the show where we put you in front of stocks that are poised to outperform the markets. And as always, we always are looking at individual industry groups. We also like to take a look at the bigger picture, kind of zoom out, make sure the markets are behind us. So let's go ahead and get started. Today's agenda, we are, as usual, going to take a look at the broader markets, take a look at where we are. Are the markets in a favorable position to keep your stocks afloat? And then from there, we're going to go ahead and take a look at pockets of strength. We are in a period of the markets. We are starting to see a bit of rotation away from those recently strong areas in the markets. We had a very, very robust period in July and August. September also up 2% month to date. So we've seen a really strong market, but within those broader markets, we're starting to see a little bit of a shift. So we're going to take a look at that shift, take a look at where the strength is within the rotation that we're experiencing now, and also review the possibility, is this a rotation out of recently strong sectors and subgroupings into newer value-oriented groupings? Is that a indication of the markets to come? And then from there, we're going to go ahead and take a look at some of the stocks with this rotation that are experiencing pullbacks. And of course, as always, you want to make sure, is your stock pulling back simply, or is it entering a downtrend? Is it time to exit that stock? So we're going to take a look at what you need to key in on, some of the key metrics that are going to be providing you with those insights. And then from there, when a fundamentally strong company sells off, and that is what we're seeing here in this period, where some of the recently strong, very, very sound, fundamentally strong stocks are starting to sell off or pull back. So let's go ahead and get started. Here we're looking at a daily chart of the S&P 500, and this is as of the close last Friday. As you can see, last week I talked about the markets having a nice uptrend here, and we can see that the S&P did in fact hit a new high in price. So very, very bullish, of course, again, into the close last week. But a couple of things I did want to point out to you that can be really quite helpful when you are looking at the broader markets, and that is putting an overlay of these simple moving averages. And let me explain here what I've overlaid. This green line, this is, of course, using stockcharts.com. The green line is a 21-day simple moving average. And as you can see with the S&P 500, it does have this tendency to pull back to this key moving average, as it's done here recently, and then bounce off. Going back historically, this red line, that's your 50-day simple moving average. And this is going to be really powerful as far as pointing you toward potential deterioration going forward. If we see these broader indexes, particularly the S&P, break that 50-day simple moving average on big volume. I'm taking you back to the end of January, where it's difficult to see, but the volume was quite large during this break, and that really was very, very telling as far as future possible deterioration. But for now, we're well above that. And then, of course, your 200-day simple moving average is the blue line. And generally, when we see breaks below that, that is going to be equally telling as the 50-day. But let's take a look at the price as of last Friday. We can also look at a current view. But what I'm keying in on here is the price versus the position of that 21-day simple moving average. You can see a fairly expansive space here, for lack of a better word. And oftentimes when we get extended to these types of levels, you will see a pullback. This is something I reviewed in my weekly report over the weekend, the fact that we very well are due at the very least a pause and then potentially a pullback. So we're going to be keeping an eye on the position of this S&P relative to that upward trending 21-day simple moving average. But given any kind of pullback, we are still very much in an uptrend. So we have the broader market's health and the strength behind us, but let's go ahead and drill down even further. And of course, what I like to do is go ahead and look at this, what's called candle glance. This is accessible on stockcharts.com from that initial interface page. And this is a snapshot or thumbnail view of various, in this case, I've overlaid or input different indices and ETFs so that we can really capture the strength where it is currently in the markets with an eye toward capitalizing on that strength. So what I've done is input various ticker symbols. These are the S&P 500 ETFs, XLI Industrials, XLK are technology, and then the broader market indices as well as the 10-year yield on that treasury. That's a critical component of the market leading into the Federal Reserve's meeting coming up this Wednesday. So we want to key in on that. So let's go ahead and take a look. What I've done is then overlaid an indicator, in this case the RSI, and that's a relative strength momentum indicator. So from there you can go ahead and sort this list descending, and it's going to provide you a lot of information on one page because now we have a sense of where the strength is. We are going to get strength to weakness, upper left side is your strongest, in this case, sector, and then so on. So let's just take a quick look and a review. As we can see, healthcare is currently the strongest on that relative performance level momentum, and a lot of that has to do with strong underlying dynamics, and we've talked about this over the last 3 weeks as far as the fact that healthcare has a number of positive characteristics in its place in place for this given group. And it's not only the fact that the dynamics within pharmaceutical companies, we've talked about the pipelines being robust for a lot of these big pharmas, but also healthcare stocks are viewed as defensive, so that if the economy were to falter or if we were to have a period of uncertainty, there is going to continue to be a need for the products that these healthcare companies provide. So it does have that stability in essence. So we have growth pockets coupled with stability that's really powering this particular industry group to the forefront. And then from there, we can see the industrials. And last week, the Dow Jones Industrial Index hit a new high in price, joining the rally in the other two indices. But the Dow, surprisingly, is now leading the broader markets. And a lot of that has to do with the rotation that we are going to go ahead and dig into. And from there, we can see that this $ TNX is going to provide you with a view of the yield on the 10-year treasury. This is something that's really being paid attention to as interest rates rise. Various industry groups are going to be impacted differently, and really within that 10-year yield there is a benchmark percent that the markets have been really keying in on, and that's 3%. If that yield goes up above 3%, you will start to see a domino effect as far as other industry groups responding. And we did get that last week. The 10-year yield popped up above 3%. It even touched 3.1% at one point. So we are going to dig into the impact there as far as the rotation. And then here we are with the S&P followed by the industrials. The industrials had been sitting out, but we can see that today industrial stocks are getting hit. This industry grouping, the industrials, we can take a larger view here, and I'll show you the fact that the industrials can be very impacted negatively or positively by trade war fears. And of course, today there's a lot of talk as far as China stepping away from the negotiation table. So there is trade war fears that are bubbling up to the surface. So these industrial stocks are being impacted negatively. We can see that they're down 1.65%. But let's go back to our snapshot view here, and we can go ahead and take a quick look at some of these other areas that are experiencing weakness. We're starting to see small cap stocks that had been really leading the markets earlier in the year, but for the month of September, these the smaller names are starting to come under a little bit of pressure. They've had these extensive moves, so a lot of these stocks within the smaller space are pulling back. Small cap stocks are what are called risk on because they have an inherent volatility in them because they are smaller. So when the markets get a little shaky, you will see a pullback, but we were seeing a pullback even prior to this week's trade war fear, certainly today. And so consumer cyclicals, this is another area that led the markets to new highs going into the month of September. We are seeing a rotation in consumer cyclicals, and then recently strong technology stocks. We're seeing a little bit of a rotation, but really the one area that we are seeing the biggest rotation into are financial stocks. So let's go ahead and spend some time taking a look at financials, because really last week the move into this industry group was certainly one of the more dramatic. So what we are looking at here is a daily price chart of the financials. So you can see this significant move that the financial stocks, they're paring back just a bit today with the broader markets. But I'm going to show you a weekly view of this XLV. And you can see that financials, for the most part, this is taking you back to the beginning of 2018. And for the most part, financial stocks have sat out this rally. We've had pockets of strength here. This is July into August, but for the most part, and let's go ahead and take a quick look. I'm going to pull up XLK as a comparison to see the difference between XLK has been in a virtual uptrend for most of 2018, but again, XLF has not. And some would argue that that has a lot to do with the fact that interest rates really have been in a go-nowhere environment. And last week, we did see that pick up over that 3% yield. So banking stocks were very positively impacted. Now, there were pockets of strength within financial, and I've reviewed those over the last few weeks. A lot of the payment processing companies, and this has everything to do with an expanding economy, with consumer that are opening their purse strings, so to speak. This is GPN, and this is Global Payment. They are a global payment processing company, and you can see within financial, despite the lack of traction in the banking stocks, there were pockets of strength. But let's go ahead and take a look at the groupings within the financial space that are starting to see upward movement outside of those payment processors. So what we're looking at here, again, stockcharts.com, on that initial page, you can get what's called a sector summary, and that's what we are viewing now. I have this sorted by 1 week, but of course you can do intraday and look at the view from there. But 1 week is going to serve us well because last week was that move into the financials. We want to see what took place last week, again, with an eye toward those pockets of strength so that, again, you can potentially capitalize on that. So here's a view. This is that 1 week. This is not 1 day. And initially it's going to be sorted by percent change. And you can see that the life insurance stocks really had a big move, 3.63%. And for those of you that are familiar, insurance companies do have a lot to benefit and gain from higher interest rates. They have a substantial portion of their investments are in interest rate sensitive assets, in bonds. So their profitability will rise and fall with interest rates. So it makes perfect sense that they were last week one of the better performers. Let's take a look at how we can embrace and get our arms around the stronger names within insurance with an eye, again, toward capitalizing on the strength. So here again, over the last week, we are taking a view of those bigger performers. And a lot of times these moves might not be as interesting as far as already having experienced an extensive move. So what we can do from here is go ahead, overlay your cursor on top of that ticker symbol. And what we can very clearly see at first glance is the fact that these big movers are really these underperformer, down and out, potentially turning. So this is UNM, Unum Group. This is that underperformance that we talked about, gaps down. This stock would not interest me. When I see a gap down similar to this May period, I'm going to think that it was earnings related. The company may have disappointed. It is starting to turn. You could potentially be getting a reversal here, but we still have a downward trending 200-day simple moving average. Now, that said, really short term, we are getting some positive signals. We could see a rally up to that 200, but beyond that, we'd need to see a break above it in order for this stock to get interesting. So let's go ahead and drill down further. From my work, I would ideally like to see stocks that are a little closer to their one-year high in price. So again, a lot of these bigger movers are really down and out stocks. And certainly we can take a look at them because this is Prudential Financial. And this one actually is quite a bit more positive because what we are seeing here is this decline. This is taking us back to that February peak in the broader markets. And you can see how this particular stock and insurance stocks in general have sat out a lot of the market's rally. But let's take a look at where we are now with PRU. The stock has broken up above not only its 10-day, that's that green line, your simple moving average, also above your 50-day, and the stock has broken above the 200-day. So now we have three simple moving averages, areas of potential resistance where the stock has been met with resistance. It's now been able to break back above. And we also have an RSI that is positive as we do a MACD. When we see these breaks above these key moving averages, we want to see volume. And we did see that volume last week. So I would put this on your radar screen as a potential reversal. What you're going to want to see is a continuation. It's not going to keep going up. We had 5 strong days, so it is due certainly a pause or a rest, but you want to pay attention to the volume characteristics on a daily basis. Today, it does appear poised to continue to trade to the downside. If that volume dries up and stays low on the down days, up volume on the up days, that's really going to serve you well. So let's go ahead and take a look at other sub-industry groupings within financials. We're on the prowl for these pockets of strength. That's going to take us to banking stocks. And bank stocks, they're another area that are very impacted by interest rates. Higher rates do benefit these banks because they do lend assets or lend capital out at those higher rates, and then their profit margins can potentially improve. So what we're seeing here is, again, 1 week, these big performers here. But what I like to key in on is Scooter. That ranking is another way for you to get in front of these potentially strong stocks. And the Scooter is a bit of a longer term technical indicator that was developed by John Murphy. Stockcharts.com is super powerful indicator. So as we take a look, we want the Scooter to be high, but if we go ahead and look at the thumbnail, you're going to see a lot of these are already hitting new highs in price. So potentially you can drill down. Another really powerful way for my work to sort this is by the market cap. And when you're seeing moves, it can benefit you sometimes to pay attention to some of these bigger stocks. And so let's take a look at JP Morgan, certainly a well-known stock in the banking industry. And you can see that this stock very much in line with the sector movement. So JPM had a very bullish move last week. It broke out of this base, and it did so on very big volume. We can see that volume. Now, we talked about earlier, it's not going to continue to go up endlessly, so you would look for some sort of a pullback. Let's take a look at this move here. This is, I talk about stocks coming out of bases, and JPM did just that last week. Your RSI is positive, and your MACD just turning positive now. So this is definitely one for the radar screen, one that you, it looks super constructive and positive here. Let's go back and take a look at another banking stock that does look also equally compelling here. Of course, my computer's bumming out here, but let's take a look. I talked about sorting it by market cap, getting in front of some of these bigger names potentially that are poised to benefit. from this uptick here in interest rates. And another stock that we can key in on here is, let's take a look. This was a name that I wanted to look at. Now, this one is not quite positive yet, but we can certainly take a look. This is STI SunTrust. So I talked about pockets of strength, and not everywhere and every area within banking is participating. What I want to do now is go ahead and pull up KRE. This is the regional banking ETF, and we can see that despite an uptick in interest rates, regional banks just are not participating. And these are going to be some of your banks that are certainly smaller than the JP Morgans of the world. So with that, we can take a look at STI. This is the biggest holding within that regional banking ETF. Take a look at this hit the stock took, and this is taking us back about a week and a half. This is on analyst downgrades, and you can see really how impacted the stock got. It broke down two significant 5% declines over 2 days, huge volume. So what we want to key in on for a potential reversal here is action similar to back here in the July period. We need to break back above this 50-day simple moving average. We need the RSI to get up above this net neutral and turn positive. And your MACD is very much in negative territory below that zero, poised to turn, but take a look. This is what we're going to want to see for a potential turnaround. But more importantly, the pockets of strength are in those big money center banks. We can take a look at Bank of America, JPM. This is where the strength is in the financials. Now, I talked about looking at whether a stock is pulling back, or is that stock really going into a downtrend. And this is going to be important given the dynamics in the current market environment. So what I wanted to do was take a look, and I have two examples of a stock where you can temper your response based on whether the stock is very simply or merely pulling back, or is that stock entering into a downtrend. What we're looking at here is Weight Watchers, WTW is the ticker symbol, and this stock had a really nice advance in the middle area period, second and third quarter here of 2018. And actually it was on our suggested holdings list. So we were able to take advantage of this move with MEM investment research here. But we did, of course, remove it. And here is why. Here are the first items that you want to pay attention to. What I'm pointing out here is a pullback, and this is taking you into the beginning of May, the beginning of June. The stock did have two periods where it did very simply pull back. And what we can pay attention to as far as determining whether that it was simply a pullback is the fact that the stock did pull back and find support. You're going to want to pay attention to this 50-day simple moving average. That's your red line. And we can see also you want to pay attention to volume metrics. So the stock pulled back here. Take a look at the RSI. It remained positive. So this is very clearly one signal that you can utilize to help tell whether it is simply a pullback or not. To pay attention to the stochastics. Stochastics did pull back a little, but they stayed above this net neutral zero. So let's take a step further. Take a look. We had this pullback down below the 10-day simple moving average. In this instance, we had the RSI eventually trend negatively. So here's your first signal that it may be more than just a pullback. Stochastics had this negative, very pronounced negative crossover, but we're still in positive territory. We're above zero, so you could potentially stay with that stock. You're going to want to look at the volume characteristics. However, now your RSI is very much in negative territory. So for here during this period, you are going to want to really tread very lightly. Once the stock breaks the 50-day simple moving average, all bets are off. Take a look at this huge volume. The institutions are in there selling. They don't want to own the stock. They don't. And as institutions reduce and unwind their positions, it's going to take some time. So this is what we're seeing here during this period. So those are some key signals. Let's take a look at another example. Western Digital, WDC. Very similar dynamics where the stock breaks below that 10-day simple moving average. Take a look at the RSI. The RSI breaks down below this net neutral. So that's going to be your signal. Your RSI has a negative crossover, black below the red. Now, once the stock breaks that 200, again, you want out, because take a look at these big volume characteristics. Institutions, again, want to exit this particular stock. Now the stock, your simple moving averages are in a downtrend. So instead of finding support at these upward trending simple moving averages, now these averages are acting as resistance. So the stock is very clearly in a continued downtrend. So this is what you are going to want to pay attention to and key in on. Now, I talked about one last item that we can go ahead and take a look at, and that is the concept of these fundamentally sound stocks that are getting really pulling back with the broader markets. So let's take a look at a bigger, well-known name. Take a look at Amazon. And this is a stock that has triple digit, over 200% earnings growth prospects for 2018. We are in a period where the stock analysts are continuing to revise estimates higher on this super already fundamentally sound stock. But let's take a look at what the stock has been doing here recently and what we will need to pay attention to. We can see Amazon hit a high back at the end of August. It's had a bit of a difficult period here. Let's go ahead and take a look at a monthly. It can give us a bit more in the way of perspective, and we can see that realistically on the monthly, the uptrend is very, very firmly in place for this stock. As a simple moving average on the monthly, you will want to use 6. 6-month is your area of support. So longer term, Amazon is very much on firm footing. We're doing fine. But what we want to pay attention to here is the daily. The stock is down 5.5% on the month. And I'm going to go ahead back to that 10-day for this daily. So what we want to again key in on is the price action relative to these simple moving averages, using history as your guide. So what we can see here is the Amazon is today broke below that 50-day simple moving average, and it is finding buyers. It does seem to be an area where institutions and investors are coming in. But if we see a close below that 50-day simple moving average, and we see that on big volume, that is going to be concerning. But let's take a look, go back historically. This is something you can do for each of your stocks that you own. When we see breaks below, go back historically and see, has the stock been able to withstand these price breaks and been able to recover? And in this case, we can see that Amazon did have this prior period here, broke below the 50-day, and it did so for over 2 weeks, but it was able to recover. So you would want to keep that in mind, and also pay attention to the longer term metrics. If you're more of an investor as opposed to a trader, you can certainly stay with the stock as opposed to you can put your money to work in some of these newer pocket areas of strength, such as the financials. And then very quickly, can't leave without talking about oil. OPEC is keeping their oil output steady. It's really pushing up oil prices. They're at a 4-year high, crude oil. So what we can do, I'm not going to have time to really drill down, but what you can do as far as uncovering stocks within oils is, again, using that sector summary page, and then the industry. Go ahead down to the energy stocks, E&P, sort it by scooter, and get in front of those big movers. I'm going to leave it at that. Take a look at MEM Investment Research. Reach out. Any further questions, elaboration, would love to hear from you. Have a great week.